There are two camps, right? You're either on, this is, first of all, the most unloved, bull market probably ever. But what comes next for Treasuries?
I think Treasury yields go higher year on year for a number of years now. We're still near record lows. We're not at record lows on yields, but you've got nominal growth at 4.5%. That's likely to improve. We think you're going to see the early signs of inflation emerging in Q2 this year as you get off a very low price base in last year. You've got a weaker dollar, higher commodity prices. There's going to be some prospects for wage growth. All of that leads to a subtle, slow appreciation in Treasuries.
Right.
There's also potential for a rout because a lot of things could come together. If there's Trump's protectionist policies, if it turns from rhetoric to reality, Japan and China don't need the $5 trillion they have in U.S. Treasuries to fund their current account surpluses if we get into that. So there's things that are wild cards, but I think everything being equal, we get higher Treasuries and potential for a sharp move if some other things come together.
Okay, Patrick, let me bring you over to my chart, and then I want to also get Viraj to talk on this. So this is our chart, and it started with also Jeffrey Gundlach talking about where he sees it, also saying that if there is a repricing of Treasuries, it would hurt a lot of the equities. But if there was, I don't know if it's a shock or something, a compendium of things coming together, where would Treasuries be, the 10-year?
Well, I think you'll get Treasuries above 3% this year if everything just goes according to our base case. And I think you could see them getting up to 3.25%, but not ending the year there, 3.5% maybe, even if you worry about the deficit at the same time as protectionist policies, and you've got bond vigilantes coming in and inflation hawks, all those things coming together.
Viraj, do you agree? Is your base case a kind of, a move, but that's actually quite stable?
Yeah, it's an orderly increase in yield. So our base case, we're a bit less sort of optimistic, sort of 2.8%. But the real key point in our world to make is that the dollar's trading under new rules, right? These rules that rising US yields no longer guarantee dollar strength. We need to take a step back and ask ourselves, what is the catalyst for driving these US yields higher? Now, it's like greater bond market synchronicity. Then you don't have this divergence story playing out anymore, and that just takes away an added layer of upside in the dollar, and we just think there's better opportunities elsewhere in the rest of the world.